Hi everyone, today we are going to discuss Q3 performance of DCB Bank. DCB Bank, which is a small-sized private sector bank, reported a very strong performance in Q3 FY19 with net profit increasing by 51% on a year-on-year basis, aided by strong loan growth and controlled expenses. DCB is a retail-focused and an SME and MSME-focused bank and stands out for its comfortable asset quality. Bank has seen a steady improvement in return ratios in the past 1 year, which makes it worth a consideration in an environment where large part of the banking system has been rendered weak and NBFCs have been stepping back following liquidity crunch. So let's look at the key positives from Q3 FY19 performance of DCB Bank. DCB Bank reported advances growth of 23%, which is very healthy and slightly better than the industry average, though on a smaller base. Bank's net interest margin was stable at 3.83%. The key highlight for the quarter for the bank was significant improvement in the operating efficiency, which was a key driver of its profits. Thanks to the controlled growth in operating expenses at around 5% on a year-on-year basis, bank reported a significant decline in cost-to-income ratio, which came in at 55% and improved by almost 710 basis points on a year-on-year basis. Bank's asset quality is also relatively better and as compared to the peer group. Its gross non-performing assets stood at around 1.9%, though it inched up slightly during the quarter. This was mainly because of the fraud reported in its commodity funding business, and as a result, the slippages and provision was slightly higher for the quarter. Nevertheless, net non-performing asset was stable at 0.7%. Bank has been efficiently utilizing its capital and this is very much evident as the risk-weighted asset growth was much lesser than the overall advances growth for the quarter. So let's look at the key negatives from DCB's Q3 FY19 performance. Bank is targeting a loan book growth of 20 to 24% per annum. The target is very modest considering its small loan book size, which is less than 1% of the overall banking system average. Bank's funding profile also remains very average with the share of low-cost CASA deposits at around 24%, which is much lesser than the industry average of around 35%. So what's the outlook on the stock? The bank had earlier guided the targets of return on asset of around 1% and return on equity of around 14% by Q4 FY19. Bank almost achieved its target in Q3, which is very encouraging. Going forward, we see sure but moderately paced improvement in bank's return ratios driven by balance sheet growth and operating leverage. On the valuation front, the stock is currently trading at 1.8 times FY20 book. We see the valuation to sustain, though it is at a premium to most old private sector banks because the improvement in profitability is quite possible. Capital raising can be a catalyst in medium term. With no rooms for valuation re-rating in the short term, the upside to the stock price will be in tandem with earnings growth. Nevertheless, long-term investors should buy the stock if there is any weakness.